Okay, let's dive into this. Welcome to today's explainer. Look, we are looking at a space right now where the stakes literally could not be higher, and that is data security in consumer finance. Think about it. Every single time we swipe a debit card, take out a personal loan, or just transfer money online, we are entrusting these massive financial institutions with our absolute most sensitive information. But how do we actually know they're protecting it? And, more importantly, how are they held accountable when things inevitably go wrong? Well, today, we are going to trace the exact accountability arc that forces these institutions to measure, report, and actually take responsibility for their digital vulnerabilities. To really understand this, we're exploring the super rigorous SASB standards. These are now maintained by the International Sustainability Standards Board, by the way. And listen, this isn't just some loose set of guidelines or a gentle suggestion. It is the authoritative framework for sustainability accounting in the financial sector. So we're not looking at vague promises today. We are looking at the exact hard metrics that force consumer finance entities to bear their vulnerabilities to the whole market. They can't just put out a PR statement hiding behind, taking security seriously. No way. They have to show the receipts. So here is our roadmap for the explainer. We're going to start with the data security threat, move right through tracking data breaches and the human impact. Then we'll calculate measuring financial damages, classify those fraud losses, and end on exactly why these metrics matter. Starting with part 1, the data security threat, defining the stakes. Right, so before we even get into the raw numbers, we need to define the absolute nightmare scenario. The SASB standard actually explicitly lays out the consequences of a breach. Failing to manage these threats effectively, well, that leads directly to decreased revenues because of lost consumer confidence. Nobody wants to bank where their data gets stolen, right? It also highlights the risk of high employee turnover, incredibly lengthy and miserable litigation, and just severe monetary losses. It's basically a domino effect that starts with one little digital vulnerability and ends in massive financial pain. Now, when we talk about external threats, what are the bad actors actually attacking? In strict regulatory terms, we're talking about information systems. And these are the physical and virtual infrastructures that are controlled by the financial entity. It's the whole network organized to collect, process, maintain, and share information, just to keep operations running smoothly. This is the digital fortress that institutions are tasked with defending day in and day out. Moving on to part 2, tracking data breaches, the funnel technique. To measure when that digital fortress is actually breached, SASB uses a specific metric. It's called FNCF230A.1, and this brilliantly illustrates what I like to call a funnel approach to force absolute transparency. An entity can't just throw out a single confusing number to the public. They have to break it down in 3 very clear steps. So step 1 is the total number of data breaches. Step 2 narrows that down to the percentage of those that are personal data breaches. And step 3 gets to the absolute bottom line, the exact number of unique account holders affected. It starts broad and then funnels right down to the exact human cost. Let's define the very top of that funnel first, the data breach. Broadly speaking, this covers literally any unauthorized occurrence that jeopardizes the confidentiality, integrity, or availability of the system. Think of this like someone breaking into the financial institution's main office building lobby. They bypass the security perimeter, which is obviously a major issue, but they haven't necessarily accessed the secure vaults in the back where all the customer files are kept. That's the broad view. Let's look at part 3, the human impact, getting personal. So, what happens when those bad actors actually get into those secure vaults? Well, this becomes a personal data breach. It's an incident resulting in the unauthorized access or loss of personal data, basically information that relates to an identified or identifiable living individual. To go back to our analogy for a second, a standard data breach is breaking into the lobby, sure, but a personal data breach is stealing the keys to a specific customer's private vault. Suddenly, your highly personal information is just out there in the wild. And here is a totally crucial point. What if the bank comes out and says, hey, don't worry, the stolen data was encrypted? Well, the SASB standards are incredibly strict here. It absolutely still counts as a personal data breach if the hackers acquired the encrypted data along with the encryption key. It also counts if there's even a reasonable belief that the hackers can easily convert that data back into normal, readable plaintext. So an institution simply can't hide behind encryption if the lock itself is easily broken. Which brings us finally to the bottom of the funnel, the total number of unique account holders affected. This is the final human metric. The institution must isolate and report the exact number of actual individuals exposed. And there is a very strict rule applied here. If the bank cannot verify that multiple compromised accounts belong to the exact same person, they are forced to report them separately. This is huge because it actively prevents companies from intentionally underreporting the true scale of the damage. On to part 4, measuring financial damages, the hard dollars. Okay, so the accountability doesn't just stop at exposed accounts. It moves straight into the actual financial fallout with metric FN CF230A.2. Financial damages are strictly calculated by real, tangible dollars. First, they measure the total value of transactions that the bank actually had to refund to account holders because of fraud. Second, it includes fraudulent transactions that the entity then charged back to merchants or their acquiring banks. So we're talking about losses from the unauthorized use of revolving credit, debit, and prepaid debit cards. This metric tracks the actual monetary bleeding caused by a failure in security. Part 5, classifying fraud losses, digital versus physical. Now, it's not enough for the bank to just give us a total dollar amount and call it a day. The standard requires a really strict dichotomy here: card not present fraud versus card present fraud. So card not present, or CNP fraud, represents your modern digital cyber threats. These are the non-face-to-face transactions, things done online, over the phone, or by mail using just the card number and the security code. On the flip side is card-present fraud, which is your traditional, old-school physical theft, where a stolen physical card is used face-to-face with a merchant. Isolating these two specific things really helps viewers and investors understand exactly what kind of attacks the institution is actually failing to prevent. And, of course, the standard includes a catch-all bucket literally labeled other fraud, because they want to ensure absolutely nothing slips through the cracks. It specifically requires tracking the financial losses due to identity theft, along with any other fraudulent transaction that just doesn't fit neatly into the card not present category. Finally, part 6, why these metrics matter. Market trust. So you might be wondering, why are we digging so deep into the weeds of these technical metrics? Well, because consumer finance is built entirely, 100%, on faith. When you look at the sheer volume of requirements on the SASB standard, it is stark, and man, it is demanding. If a financial institution cannot accurately track the number of breaches, the exact human beings affected, and the precise dollars lost to digital versus physical fraud, they simply cannot be trusted to protect your wealth. These metrics are effectively the ultimate lie detector test for a bank's security claims. Which leaves us with a pretty critical thought to end on today. These standards exist to force the consumer finance industry into the light, but ultimately, it is up to the market and up to us as consumers to demand that data. So ask yourself, is your financial institution actually transparent about its vulnerabilities? Or are you just another metric waiting to be reported in next year's data breach funnel? I highly encourage you to dig deeper into how your own institutions measure up. Thanks so much for joining me on this explainer. And remember, keep asking the tough questions.